I think not. The question is the timing. Now, clearly, as long as central banks continue to keep interest rates artificially low, continue to print money, continue to force banks to buy bonds, and continue to buy bonds themselves. The Swiss central bank is buying bonds in all sorts of weird and wonderful companies, as is many other central banks. That will continue to be a feature. But when it goes the other way, it's going to be, it's going to be incredibly volatile. It's going to be incredibly turbulent. We know that liquidity in fixed income markets is down by about 2/3 on the back of regulation to stop risk-taking activities of investment banks. So all of these things are going to conspire at some point in the future. The question is timing, and it still seems a way off until we see sustained inflation coming through, and until we see unexpected interest rate increases coming through in the US. The bond markets and bond proxies in the equity market are likely to continue to rise, but it's a game of chicken, and it's one that we're not really willing to play in. So we have very little interest rate exposure, and we have very little exposure to the bond proxies in the equity markets. Yeah, so we still have fixed income exposure. I mean, I think, again, it's a question of timing, and you don't want to position everything for one outcome, because even if you're right, it can take quite a long time to come through. And our view in sterling is a demonstration of that. That was a number of years it took before that was realised. The other thing as well with fixed income is you do actually get a yield from it. So if you have a negative position on it, you're giving up that yield. So we like the credit aspects of fixed income markets, and we're exposed to that. We don't like the interest rate sensitivity. So the bond exposure that we have is very, very low in interest rate sensitivity, but it has some credit exposure in there, and that's working reasonably well. I think the key risk is unexpected rate increases coming through. So if we see inflation pick up in the US in a sustained manner, that will usher unexpected interest rate increases. The market will always price in interest rate increases which are now announced in advance. But if we look back to the early 90s, and particularly late 1993 and early 1994, it's when the central banks shock the market with unexpected rate increases that then causes the sell-off.